So we've got a special guest now joining me for the remainder of the show. That's hedge fund manager David Berman. He specializes in the consumer and retail sectors. Fortune magazine called him king of the retail jungle, so we like to recycle that because it's kind of a fun little moniker.
Thanks for having me, Margaret.
It's good to have you on, David. And you've been on the show a number of times. Back in May, you told us that the environment, as you saw it, was retail nirvana for retail stocks.
Last year this time.
That's right.
Last year this time. And then May, it was no longer retail nirvana.
And so what is it now? Where are we in the consumer environment?
Well, it was no longer it was retail nirvana a year ago, simply because America was buying much cheaper from overseas, so sourcing costs were coming down, and also they had easier comparisons for sales. And importantly, Walmart was taking their foot off the pedal according to what we were seeing. Then when it came to May, we downgraded the sense of the group from retail nirvana, and that is because sourcing costs are now starting to go up. As you've started to see in some of the PPI numbers, you're starting to see higher prices.
Right.
Cotton
had told us that on the show, said that sourcing costs are going up, and they're passing that on to stores.
That's a problem heading into next year. Some of the retailers we speak to who do apparel are probably seeing 5 to 10% increase in their costs from China, for example, because of high labor and higher cotton prices and things like that.
So that inflation is happening on the sourcing side. What's going to happen on the consumer side of things?
Well, on the consumer side, so obviously that's going to hurt profits if costs go up, margins, right? So if the retailers can pass that on, as some are saying they can, well, then it's actually can be quite good for the retailer, because then what happens is they have good top line, and hopefully it'll more than offset the costs, and at the same time they get leverage on the SG&A from having higher same-store sales, which is another way of saying that there'll be inflation.
Right, and we have some of your breakdown of how you look at same-store sales, and I know it's gotten a little bit more difficult because not all stores release figures on a monthly basis any longer. Walmart among them.
Walmart stopped about a year and a half ago.
And you actually also on this program were out there early drawing attention to what you saw as Walmart not being as price aggressive, not cutting as aggressively as they had in years past. This idea has recently caught on because JP Morgan came out and said prices at Walmart are actually about 5% higher than they were last year. So
this is probably for the last month. They go back and forth. It's maybe based on a study for the last month. Yeah, they are higher now. They are higher now. They go back and forth. I think Walmart is a bit confused. I'm not sure if there should be a chart there of Walmart's gross margins and their same-store sales. But what happened was you saw from their gross margins that they were going up. The change year over year was going up about a year and a half ago. So from that, you knew that they weren't passing along the prices to the consumer, and that would help everybody. We talk about Walmart a lot because, I mean, it's unbelievable. They're 24% of total sales of publicly held companies in America.
I mean, they're
publicly held companies. It was about 10 or 12% of total sales in America.
But it's a global economic indicator in many ways.
And what they do with pricing affects the whole group. It affects, Kohl's, and it can affect Target, and it affects Macy's even to some degree. So we watch them very carefully, and what they say is not always what they do. They always say they're going to have the lowest prices, but that's why we have to rely on JP Morgan and other firms to do pricing. Mosaic do a good job as well of doing pricing studies, to show you what's really going on and what happened. So essentially, right now, it seems like they may be looking for other ways to grow sales, not through lower prices.
Well, it's interesting to see. We talk so much in the economic front about deflation, but inflation, at least when it comes to retailers and what they're having to buy to put on their shelves. Talk to me though about the overall environment in retail right now, because we have seen some M&A activity, the takeout of Gymboree by Bain Capital. Do you see more activity in the consumer space?
Well, it's really interesting that I would expect that we would see more. I'm surprised that it took so long for them to do it.
Why?
Well, we were sitting here in August. We downgraded our group in May, and by August the group had just been completely obliterated, and you had a lot of stocks that were trading at half of their cash value. Gymboree, for example, I can't remember. I think it's around about $10 a share in cash, but they were trading at $40. That's 25% of their market cap was in cash. And we were sitting there thinking, gee whiz, these companies are so low. Timberland's another example. $7 a share in cash, and the stock was at $18. Almost half the market capitalization is in cash. And we were sitting here thinking, well, why aren't people buying these companies out? But they weren't doing it. They weren't doing it before. They didn't do it 6 months ago, 8 months ago. They didn't buy Gymboree when the stock was at 20, 30.
Why do you think there was that apprehension? Just fear of the consumer, or
That's
that those
correct.
valuations weren't enough?
I think that is probably the main reason, the fear of the consumer. They were worried that there was no stabilization in the economy. What was going on about that? The passage of time has allowed us now to see that the consumer is indeed stable. According to our same-store sales graph, which you guys have, it shows the same-store sales have been very stable the last 6 months. They've been running at 3.8%, between 3.6 and 3.8% consistently, which we've never seen that kind of consistency. Yeah. So because I think of the consistency, they're feeling more comfortable in buying. And secondly, it's been easier for them to get credit, and that's a big part of private equity, as you know. They can borrow much cheaper than they used to be able to do a year ago.
We've been looking at the retail and the consumer space. I mean, we're in the all-important period for the stores, the fourth quarter here. Yeah. Talk to me about where inventories are versus sales, because that all adds up to how much you and I pay at the register, right?
At the end of the day, it does. At the end of the day, what we pay the register is based on the markdowns that we might have, and those markdowns are based on how much inventory is in the stores. And the stores have too much inventory, then there's going to be a lot of sales, and that's good for the consumer. It's not good for the consumer when there's fewer inventory. Like, by the way, like there is an aircraft. They've cut back a lot of aircraft, and we're finding ourselves paying a lot of money to fly on planes, which I'm flying this afternoon. It's a bit annoying, but it's the same type of thing with for the consumer.
Apparel, you expect prices. You don't expect price cuts.
We're not going to have the same thing. We're not going to have the same thing we had 2 years ago when things were really bad. I remember Saks had a big issue with inventories. I remember how everyone was like rushing there. They had a 70% off sale. You could buy whatever you want. It was unbelievable. I mean, those days are gone. The inventories are really well controlled, particularly at the high end, like at Saks, at Nordstrom's, Neiman Marcus. They're doing a really good job of controlling inventory. So for the most part, you won't see the sales this Christmas that you saw 2 years ago. It'll be probably more like last year, because they had, by that stage, they already got their inventories under control. But what we do is we summarize every retailer on the DB index, and we have a graph on that. And essentially what you can see from that graph is that the sales to inventory ratio is
you've got it up now.
Yeah, if you see the end of it, towards the end, you'll see on the far right hand side that it's actually gone down, and that's bad. That's bad. The trend is bad. In other words, and that's
Wait, what do you mean there? That stores don't have as much on their shelves, and that's a bad thing?
No. That it's a bit complicated. It's still good because sales for the total all the retailers in America that reported last quarter were up 4%.
Right. So talk to me about the shopping that the stores are doing themselves. Are you expecting more retailers to go out and buy back their shares?
Well, I'm not a big fan of share buybacks. I'm a big fan of paying one-time dividends in retail.
That's
for
how
the
you
most
like
part.
To see the cash allocated by
And we have this big discussion, and I have these arguments with managements about it. It's an interesting discussion on its own, and I don't know if you want to go into it here, but essentially, companies like to do buybacks, and shareholders like to do buybacks for reasons that are not in the best necessary interest of the shareholders, and that is why. Management want to do buybacks for the most part because a lot of the time they have options,
right.
And options don't benefit from one-time dividends.
You're quite cynical, David, as to motivations. But well, talk about JCPenney, because there's a lot of speculation about what another hedge fund manager, Bill Ackman, might be trying to do to squeeze out efficiency or squeeze out profits here. Do you see a similar argument in that case?
Well, JCPenney, the stock is up 60% plus, maybe even 65% plus since $20 when Bill Ackman started buying, when the stock was really cheap. It had been hit from 29 and went all the way down to 20, but there's a reason why the stock was at 20. They're suffering. They're in between Kohl's and Target and Walmart, and they're getting hurt from all fronts, and that's not so easy for them.
He likes their real estate, though. He said the same thing about Target. Right?
He said the same thing about Target. The problem here is that the real estate's only about 27 or 28% of the total portfolio, and so you've already got a stock that's up 60%, and the company's in a declining subsector of retail and department store sector.
And just, we should clarify, you don't have a long or short position.
I'm not involved in JCPenney at the moment.
David, I want to ask you, where are you finding strength in retail right now, if you do want to put money to work?
Well, right now you're finding strength. Everything's relative to last year and how easy or tough comparisons were. So right now you're seeing some strength in furniture. Companies like Williams-Sonoma, Bed Bath & Beyond.
Got slammed, though,
They got
during
slammed.
the crisis. So
that's right.
It's really just about the prices being attractive to you.
The prices being attractive, and the fact that the inventories are really low, so they're actually able to get good margins, and some of the capacity's gone out of the industry. So you're looking at somewhat furniture. You're also looking at shoes on a roll. Don't ask me why. I mean, there's a shoe cycle going on right now, and that's benefiting everybody. Payless Shoes and Foot Locker, which are two of the laggards that have been doing pretty poorly, I believe in this environment are doing marginally better. We own both of those. And then you have other companies in the shoe footwear industry that are also doing quite well. You know, Steve Madden is really one of the standouts, and the retailers like Finish Line and Shoe Carnival, you know, those companies are all doing well right now. And the inventories are particularly well controlled in that subsector. And then, of course, anyone can make up their minds about Skechers. They're two sides of the fence, those tall shoes that used to like.
Right.
That's kind of like no one quite knows what's going to happen there, but you've got $10 in cash with a $25 stock, so one kind of wonders the downside. On the negative side, I'm going to speed through this.
So you like furniture, you like shoes.
I like shoes.
What worries you? Is it just overall apparel
right now? What worries me, generally speaking, is the competitive environment as we head into Christmas and the holiday season. And the weather's not been so good the last few weeks.
It's warmer than expected.
Been warmer than expected.
And you expect that to hurt monthly sales.
It should hurt, and maybe people are not expecting that in the stock prices. So you've got also what's compared to this is a missy subsector. You've seen bad numbers from Talbot's recently. You've seen bad numbers from Christopher Banks. You know, there's a bit of a trouble going on in that area, and the teen is also a little bit more competitive. And companies are being a little bit more competitive. But Abercrombie's lowered their prices, and that's hurting a few people.
Is there a dominant thesis right now? Because for the past 2 years, it seemed to be go to the discounters because that's a safe place to hide out until the consumer comes back. Is there a theme now, or is it just stock picking kind of environment, like you say?
It's amazing. There is if you have a look at a graph, basically like this. I mean,
look at you like producing the segment now.
You can actually see what's happening. I mean, department stores are flat and discounters are going up, and that trend's going to carry on. It'll be an interesting Christmas to see what happens. It'll be a lot of fun.
I want to count how many words per second you just got out there.
I tried. Boom, 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 boom.